Problem is not a problem until it is a problem. Right now, we exist in a market that's dominated by confidence. The old parable that if you have obligations of $1,000,000, you have income of $50,000, you have expenses of $55,000, but you have $10,000 in your pocket, you aren't broke till the 10,000 wears out. And then, in fact, you are broke. My concern is that the impact of the debt won't be felt until it is. My concern is that at some point in time, I'm not saying it has to happen soon or that it has to happen at all. My concern is that at some point in time, we have a 2008 style event. But unlike 2008, we no longer have the financial flexibility to print and spend our way out of it as easily as we did then. It's worthy to note that the fiscal measures that occurred subsequent to the 2008 global financial crisis occurred in the context of U.S. government debt being less than 30% of GDP. U.S. government debt is now 115% of GDP, which is to suggest, first of all, that the problem is larger, and second of all, the scope for dealing with the problem, either by way of quantitative easing or by way of fiscal policy, which is to say expenditures, is substantially more constrained. I'm not trying to say that this necessarily bites us, or if it does bite us, that it bites us next week. I am suggesting that individual investors and savers who don't take into account both debt and deficits and the possibility of a confidence-inspired liquidity squeeze are doing themselves a very broad disservice.
In a recent segment, financial expert Rick Rule highlights the alarming state of the U.S. economy, noting a staggering rise in government debt to 115% of GDP from less than 30% during the 2008 financial crisis. He cautions that this heightened debt level, coupled with diminished fiscal flexibility, could precipitate a crisis akin to 2008, but with fewer intervention options. Rule urges investors to consider mounting debt, persistent deficits, and the looming threat of a liquidity squeeze, stressing the importance of proactive investment strategies. Stay informed and navigate today's financial landscape by subscribing to our channel for valuable insights and real-time updates. Like, share, and activate post notifications to stay ahead of economic uncertainties.
Yeah, I mean, Germany's an own goal. It is their own decisions that have contributed to their demise. The idea, as an example, that you rely on Russian gas, or even stranger, that you rely on solar in a place where the sun doesn't shine, seems extremely odd. The basics of the German economy, German ingenuity, the newly liberalized, when I say newly, 20 years ago liberalized labor markets, mean that if the Germans stopped being stupid, they could start being prosperous again pretty immediately. The difficulty they have as part of the Euro community is the bifurcation of Europe, which is to say the Northern Europeans which generate wealth and the Southern Europeans that consume it. And it would seem that the Southern Europeans can consume wealth faster than the Northern Europeans can generate it, particularly given the own goals that the Germans in particular, but also the Dutch, seem to be inflicting against themselves. I need to say that the relative strength of the U.S. dollar relative to the euro says a lot about the relative performance of the U.S. economy relative to the European economy. If the U.S. economy is sclerotic, I don't know what that really means that the European economy is, but whatever the word is, it isn't a very pleasant word. I am increasingly attracted to the performance of emerging and frontier markets economies. I'm not trying to say that there aren't risks there, but when I look at the growth of the middle class and the gradual liberalization of economies in places like India and Malawi and Nigeria and Indonesia, I'm impressed with what we have the ability to achieve. When I say we, I mean our species has the ability to achieve over the next 10 years. You know, it's important that we look back over 30 years and we ascribe much of the increase of global wealth all the way back to Deng Xiaoping saying to be rich is glorious. And the incredible advances that we've enjoyed as a consequence of the increasing liberalization, urbanization of the Chinese people. And I think one of the undercurrents that we're seeing around the world is that places that were desperately poor are now merely poor. And I think part of the undertone that gives me a bit of hope is that emerging and frontier markets will provide a greater boost to the economy over the next 10 years than is broadly supposed. This is an important part, by the way, of the commodities investment thesis, too. In order for those economies to function, there is a whole bunch of material consumption, of infrastructure that needs to be consumed. If you look at the impact of on commodity production around the urbanization of China, you will get some sense of the investment that will be required to bring that level of urbanization and wealth to countries like India and Indonesia and Nigeria. But I do think it's going to occur in fits and starts, and that, I think, is extremely bullish.
Continuing his analysis, Rick Rule shifts focus to the oil and gas sector, identifying it as a promising theme for the next 5 years, despite potential global economic downturns. With government debt soaring and fiscal flexibility constrained, Rule highlights the profitability of the oil industry, particularly at current commodity prices. He points out the significant earnings potential amid ongoing political challenges and predicts sustained profitability for oil and gas companies, making them attractive investments. Stay tuned to our channel for further insights on navigating the evolving economic landscape.
I mean, the easiest theme to follow for the next 5 years or so is oil and gas. That isn't to say global synchronized recession wouldn't slow down the train. But the truth is, at today's commodity prices, the oil industry in particular makes a lot of money. And the discrepancy between in BTU pricing between natural gas and oil likely means that that delta resolves upward for natural gas rather than downward for oil. The big thinkers would have you say and believe that peak oil demand will occur in 2030 for political reasons. They neglect to say that if that happens, they won't be able to fly their private jets to Davos because there won't be anything to fuel them. Their prescription for the future is alternative energies. We have now spent $5 trillion on alternative energies, and we've reduced the market share of hydrocarbons from a high of 82% all the way down to 81%, which is to say a $5 trillion investment has made an infinitesimal impact on the market share of fossil fuels. As we bring the 3 billion people on the world at the bottom of the demographic curve up the demographic curve, part of the ascent of humankind in a material sense is all around energy and energy density. The oil and gas business, I think, will continue to be a very good business for 40 years. But the companies are being priced like the half-life of their economics is in 6 or 7 years, which is absolutely wrong. An intelligently constructed portfolio, even of oil majors, but better, including mid-caps on both sides of the 49th parallel, will outperform, I think, almost every index, equity index available in the next 5 to 10 years. First of all, these companies, despite the best efforts of their governments to wreck them, are horrendously profitable. They are making boatloads of money. Because of the political headwinds that face oil and gas, many companies, particularly state-controlled companies, Pemex, PDVSA, YPF, aren't making the sustaining capital investments necessary to maintain their production, which means that we will have production shortfalls 2 or 3 years out, which means that prices will stay firm. Even at these prices, intelligent companies are making a whole bunch of money. And there are a bunch of companies on both sides of the 49th parallel that are making the sustaining capital investments that will maintain production 2 years from now, 3 years from now, 5 years from now. And paradoxically, the political policies of Biden and Trudeau guarantee that this will be an immensely profitable business, despite all of their efforts to the contrary. This is a business that's doing incredibly well, despite the efforts of the politicians to wreck it. And I believe that voters on both sides of the 49th parallel, and in Europe too, will come to their senses. So I think that the politics of oil and gas will get better. The business couldn't get better, although it might.
Today's segment with Rick Rule has provided invaluable insights into the state of the global economy and the potential impact on various sectors, particularly oil and gas. We've learned about the looming challenges posed by mounting government debt and the need for investors to remain vigilant amidst economic uncertainties. Rule's analysis underscores the importance of informed decision-making in navigating today's financial landscape. Thank you for tuning in. If you found this content valuable, don't forget to subscribe to our channel for more updates, like this video, and share your thoughts in the comments below. Your feedback is greatly appreciated as we continue to bring you insightful discussions on finance and investment.